Good morning, good afternoon, good evening. Wherever you are in the world, thank you for being here. Before we begin today's analysis, a brief word. If you value thoughtful, disciplined financial education, content built on reason rather than hype, consider subscribing to this channel. You'll find the subscribe button below this video displayed in red. No pressure, no urgency, simply an invitation to join a community that approaches markets with seriousness and respect. Now, let's turn our attention to something unfolding in real time. Something that deserves your focus. Mexico produces nearly 1/4 of the world's silver supply. That's not a trivial statistic. It's a structural reality that underpins global industrial production, technological manufacturing, and precious metals markets worldwide. But something has changed, and it changed suddenly. Reports are emerging from northern Mexico, specifically from regions surrounding major mining operations, that organized criminal groups have intensified territorial disputes. Roads have been blockaded, supply chains have been interrupted, workers have been threatened. In some cases, mining operations have slowed or temporarily ceased altogether. And now, a secondary signal has appeared, one that cannot be dismissed. CME Group inventory data, the registered silver stocks held in COMEX warehouses, are declining at an accelerated rate. Not gradually, not in line with normal seasonal patterns, but sharply, consistently, week after week. Is this a temporary disruption? A logistical hiccup that will resolve itself within weeks? Or are we witnessing the early stages of a genuine supply shock with consequences that could ripple through financial markets for months or even years? That's the question we're here to examine today. Not with speculation, not with sensationalism, but with clear analysis, historical context, and practical guidance. Let's start with fundamentals. What exactly is a supply shock, and why should you care? A supply shock occurs when the available quantity of a critical commodity suddenly contracts, not because of changes in demand, but because the supply itself becomes restricted. This can happen through natural disasters, geopolitical conflict, regulatory changes, or in this case, security breakdowns that physically prevent production or transportation. Silver is not just a precious metal, it's an industrial metal. It's used in solar panels, electric vehicles, electronics, medical devices, and hundreds of other applications. When supply contracts unexpectedly, prices don't just drift higher. They can surge violently as buyers scramble to secure available inventory. But here's what makes this situation particularly significant. Silver markets are relatively small compared to oil, copper, or other major commodities. The total annual silver market is measured in tens of billions of dollars, not trillions. That means price moves can be amplified, volatility can intensify quickly, and when inventory levels at major exchanges begin falling rapidly, as we're seeing now, it signals that physical tightness is real. Not imagined, not theoretical, real. Let's put Mexico's importance into proper context. According to the most recent data from the U.S. Geological Survey, Mexico produced approximately 6,300 metric tons of silver in recent years. That represents roughly 23% of global mine production. Only one or two other nations come close to this output. This creates what economists call concentration risk. When a significant portion of global supply comes from a single geographic region, any disruption in that region has outsized consequences. Think about oil in the Middle East. Think about rare earth elements in China. Think about platinum in South Africa. When supply from these regions is threatened, even temporarily, markets react immediately and forcefully. The same principle applies here. If Mexican silver production slows by even 10 or 15% due to security concerns, transportation bottlenecks, or operational suspensions, the global market feels it instantly. And that brings us to the second critical factor, existing inventory levels. The CME Group operates COMEX, the world's primary exchange for silver futures and options. Physical silver held in COMEX registered warehouses serves as deliverable inventory backing these contracts. Here's why this matters. When registered silver stocks are high, it indicates ample supply. Market participants can settle contracts easily. There's breathing room. Liquidity is strong. But when registered stocks decline, especially when they decline rapidly, it suggests something different. It suggests that physical metal is being withdrawn faster than it's being replenished, that buyers are taking delivery, that someone somewhere believes holding the actual metal is more valuable than holding paper claims to that metal. Recent data shows registered silver inventories at COMEX have dropped by millions of ounces over a compressed time frame. Not a single week event, a sustained trend. Now combine that trend with disruptions in Mexican production. What you have is a tightening scenario on both the supply side and the inventory side simultaneously. This is not cause for panic, but it is cause for attention. Let's look backward before we look forward. History provides valuable perspective. In 2011, silver prices surged to nearly $50 per ounce. Multiple factors drove that rally, but one key element was investor concern about physical availability. Reports of supply constraints, both real and perceived, created a feedback loop. Rising prices attracted more buyers. More buyers depleted available inventory. Depleted inventory pushed prices higher still. Eventually, that rally ended violently. Silver crashed from its highs, and many late entrants suffered significant losses. Why? Because the rally was driven as much by momentum and emotion as it was by fundamental supply-demand dynamics. Here's the lesson. Supply shocks can create powerful price moves, but not all price moves are sustainable. Not all rallies continue indefinitely. Understanding the difference between a structural shift and a temporary squeeze is essential. Another example, palladium in 2020. Russian supply concerns, combined with industrial demand from the automotive sector, pushed palladium to record highs. Those who understood the fundamentals and acted with discipline captured meaningful returns. Those who chased momentum at the peak faced painful reversals. The pattern repeats across commodities. The specifics change. The underlying psychology does not. Every market moves through cycles: accumulation, markup, distribution, markdown. Silver is no exception. For much of the past decade, silver has been in a relative accumulation phase. Prices remained range-bound. Investor interest was modest. Production was stable. Inventories were adequate. But cycles shift. And when they shift, they often do so in response to external shocks, events that change the fundamental landscape in ways that participants didn't anticipate. The current situation in Mexico could represent that kind of shift. Not a guarantee, not a certainty, but a possibility worth monitoring closely. If Mexican production remains disrupted for an extended period, if security conditions worsen rather than improve, if inventory drawdowns continue at their current pace, then we could be entering a new phase of this cycle, one characterized by higher volatility, tighter physical markets, and sustained upward pressure on prices. Alternatively, if the situation stabilizes quickly, if mining operations resume normal production, if inventories stabilize or rebuild, then this could prove to be a temporary disruption with limited long-term impact. The point is this: we don't yet know which scenario will unfold. What we do know is that the probability distribution has shifted. The risk of a prolonged supply shock has increased meaningfully. And when probabilities shift, your strategy should adapt accordingly. Let's talk about how your mind processes information like this. Human beings are wired to give disproportionate weight to recent events. This is called recency bias. When prices are falling, we assume they'll keep falling. When prices are rising, we assume they'll keep rising. Right now, if you've been watching silver over the past year, you may have become accustomed to relative stability. Modest price action, limited headlines, minimal drama. Then suddenly, news breaks about cartel violence, production disruptions, and inventory drawdowns. Your mind shifts gears. The story changes, and with it, your emotional response changes. This is where discipline becomes critical. Because your initial emotional reaction, whether fear, excitement, or urgency, is not a reliable guide to rational action. Successful investors train themselves to separate signal from noise, to distinguish between meaningful structural changes and temporary headline volatility, to act from principle rather than impulse. So let's do exactly that. Let's build a framework for thinking through the situation rationally. If you already own physical silver, silver mining equities, or silver-related financial instruments, you face a specific set of decisions. First, take inventory. Literally. What do you own? How much? At what cost basis? What percentage of your portfolio does it represent? If your silver holdings are a modest, well-diversified portion of a broader portfolio, the current situation may not require immediate action. In fact, sudden disruptions often create short-term volatility that rewards patience rather than reaction. But if your position is large, if you're overconcentrated, then this may be a moment to reassess, not because you must sell, but because prudent risk management means regularly evaluating position size relative to changing market conditions. Second, consider your time horizon. Are you holding silver as a long-term store of value, as a hedge against currency debasement, as a speculation on rising industrial demand? If your thesis is long-term, temporary production disruptions may actually strengthen your case. Reduced supply, if sustained, supports higher prices over time. That aligns with your original rationale. But if you were trading silver short-term, hoping for quick gains, the current situation introduces new uncertainty. Volatility can cut both ways. Sharp moves upward can reverse just as quickly. Third, resist the temptation to over-optimize. Don't try to time the exact top or bottom. Don't convince yourself you'll sell at the peak and rebuy at the trough. Markets don't accommodate that kind of precision. Instead, consider systematic approaches. If prices rise significantly, you might trim a portion of your position to lock in gains while maintaining exposure to further upside. If prices pull back sharply, you might add incrementally if it aligns with your long-term plan. The key is process, rules, discipline, not emotion, not hope, not fear. Now, let's address those who don't currently own silver but are considering whether this situation presents an opportunity. The most important question is not, will silver prices rise? The most important question is, at what price and under what conditions does an investment in silver align with my broader financial goals and risk tolerance? Let's be blunt. Chasing assets after headlines break is often a losing strategy. By the time you've heard about a supply shock on the news, the market has likely already priced in at least some of that information. You're not early, you're reacting. That doesn't mean opportunities don't exist, but it does mean you need to be thoughtful about entry points and position sizing. If you believe the supply disruption is real and will persist, the rational approach is not to go all in immediately. It's to start building a position gradually, dollar cost averaging over weeks or months, accumulating on pullbacks, avoiding the urge to load up after sharp spikes. Why? Because volatility works both ways. Supply shock headlines can push prices up rapidly, but they can also lead to sharp corrections as traders take profits, skeptics push back, or temporary solutions emerge. Building positions over time allows you to average your entry price. It reduces the risk of buying at a local peak. It gives you the psychological resilience to withstand inevitable short-term drawdowns. Also, consider your vehicle. Physical silver, mining stocks, ETFs, futures, each has different risk profiles, liquidity characteristics, and tax implications. Physical silver offers direct exposure but involves storage costs and liquidity challenges. Mining stocks provide leveraged exposure to silver prices but introduce company-specific risks. ETFs offer convenience but carry management fees and counterparty risks. There's no universal right answer. The right choice depends on your circumstances, knowledge level, and comfort with complexity. Let's shift focus briefly to an often overlooked aspect of silver's value proposition: industrial demand. Unlike gold, which is primarily a monetary metal, silver has extensive industrial applications. Roughly half of annual silver demand comes from industrial uses: solar panels, electronics, medical applications, water purification. The list is extensive. This matters because industrial demand is relatively inelastic. Manufacturers need silver for production. They can't easily substitute other materials without incurring significant costs or performance trade-offs. When supply tightens, industrial buyers don't simply walk away. They bid higher to secure the metal they need. This creates a price floor that investment demand alone doesn't provide. Moreover, long-term trends favor increased industrial silver consumption. The global transition to renewable energy, especially solar power, requires substantial silver for photovoltaic cells. Electric vehicle adoption increases silver usage in electrical systems. 5G infrastructure deployment drives demand for silver in electronics. These trends unfold over years and decades, not weeks or months. But they matter. They provide fundamental support beneath shorter-term supply-demand imbalances. So when evaluating the current situation, don't focus solely on the immediate supply shock. Consider the broader context. Consider whether structural demand trends might amplify or extend the impact of reduced Mexican production. Let's address the elephant in the room. The situation in Mexico isn't just about mining logistics. It's about security, governance, rule of law. Cartel violence isn't new, but its encroachment on critical infrastructure and industrial operations represents an escalation. And escalations are inherently unpredictable. Will Mexican authorities restore order quickly? Will mining companies negotiate private security arrangements? Will violence spread to other mining regions or remain contained? These questions don't have clear answers, and that uncertainty itself has value implications. Markets dislike uncertainty. When geopolitical risk rises, investors demand higher risk premiums. For commodities sourced from unstable regions, that means higher prices, not just to reflect supply constraints, but to compensate for the uncertainty itself. This is why diversification matters, both geographically and across asset classes. If your entire portfolio depends on stable production from a single politically unstable region, you've introduced concentration risk that may not be adequately compensated. The silver situation in Mexico is a reminder of this principle. Unexpected events happen. Systems that appear stable can become fragile quickly. Prudent investors build portfolios that can withstand shocks without catastrophic damage. We need to discuss a technical aspect that often goes overlooked in commodity markets: the role of leverage and derivatives. Silver futures markets allow participants to control large positions with relatively small margin deposits. This creates leverage, and leverage amplifies both gains and losses. When supply shocks occur, leveraged traders can be forced to cover positions rapidly if prices move against them. This creates cascading effects. Forced buying begets more buying. Prices spike. Then, when positions are closed, prices can reverse just as violently. This isn't inherently good or bad. It's simply a characteristic of modern commodity markets. But it's essential to understand if you're participating directly. If you're holding physical silver or unleveraged ETFs, you're insulated from margin calls and forced liquidations. Your downside is limited to the value of your investment. But if you're trading futures or options, you're exposed to these dynamics. A sudden move against your position can result in losses that exceed your initial investment. The lesson? Match your strategy to your risk capacity. Don't use leverage unless you thoroughly understand how it works and can afford the downside. Don't trade derivatives unless you're prepared for the complexity and speed at which positions can move against you. For most individual investors, simpler approaches are wiser. Own the asset directly, or own it through transparent, unleveraged vehicles. Save the complex instruments for those with the expertise and capital to manage them properly. Let's now turn to the mistakes investors make in situations like this. Mistakes that can turn a rational opportunity into a devastating loss. Reading dramatic news about supply shocks and inventory drawdowns can trigger powerful emotions. Fear of missing out, urgency, greed. These emotions push you to act immediately without careful thought. Don't. Information takes time to process. Markets overreact initially, then often correct. Give yourself 24 to 48 hours before making significant decisions. Write down your reasoning, sleep on it, then act if it still makes sense. Using borrowed money or excessive leverage to amplify your exposure is one of the fastest ways to destroy wealth. Even if you're right about the direction, short-term volatility can force you out of positions before your thesis plays out. Size your positions so that even a 30 or 40% adverse move wouldn't devastate your portfolio. This might feel conservative, but it keeps you in the game. And staying in the game is more important than maximizing any single trade. Concentrating too much capital in a single asset, even if that asset is performing well, introduces catastrophic risk. No matter how compelling the story, no matter how confident you feel, maintain diversification. A useful rule: no single position should represent more than 5 to 10% of your portfolio unless you have extraordinary expertise and risk tolerance. For most investors, smaller allocations are wiser. Buying after prices have already surged significantly simply because they're moving upward is a recipe for buying near tops. Momentum eventually exhausts. When it reverses, late entrants suffer the most. If you're entering a position, define in advance. What price am I paying? What's my target? At what point will I admit I was wrong and exit? Without these parameters, you're gambling, not investing. Especially with physical precious metals, tax treatment can vary significantly depending on jurisdiction and holding period. Short-term trading can generate substantial tax liabilities that erode returns. Consult with a tax professional before making large trades. Understand how your gains will be taxed. Factor that into your return expectations. Sometimes the best trade is the one you don't make because taxes would consume too much of the profit. Every market cycle produces narratives that convince participants that traditional rules no longer apply, that this time it's different, that old patterns won't repeat. They almost always do. Supply shocks have happened before. They'll happen again. They create opportunities and risks that are fundamentally similar to past episodes. Study history. Learn from past supply disruptions in silver and other commodities. The specifics change, but human behavior, the greed, fear, hope, and panic, remains constant. It's easier to decide when to enter a position than when to exit. But the exit is where profits or losses are realized. It's where discipline is truly tested. Before you buy, know under what conditions you'll sell. Will you take profits at a specific price level? Will you use trailing stops to protect gains? Will you hold indefinitely as a long-term store of value? Having clarity on this before emotions run high makes it far easier to execute your plan when the time comes. Let's talk about risk management more broadly, because everything we've discussed comes back to this fundamental principle. Successful investing isn't about maximizing returns on any single trade. It's about surviving long enough to compound capital over time. And survival requires managing risk. This means accepting that you won't capture every opportunity perfectly. You won't buy at the exact bottom. You won't sell at the exact top. You'll miss some moves entirely. And that's fine, because the alternative, trying to capture every move, over-leveraging, taking excessive concentration risk, leads to eventual ruin. Risk management means position sizing appropriately. It means diversifying across asset classes and geographies. It means using stop losses or position limits to cap downside. It means keeping adequate cash reserves so you're never forced to sell at inopportune times. It also means emotional management, controlling your reactions to market volatility, not checking prices obsessively, not making impulsive decisions based on short-term moves. The investors who compound wealth over decades aren't the ones who make the biggest single bets. They're the ones who consistently make sound decisions, avoid catastrophic mistakes, and stay disciplined through cycles. That's the goal here. Not to predict whether silver will hit some specific price, but to position yourself intelligently given current information, manage your risk prudently, and maintain the discipline to adapt as conditions evolve. Before we conclude, let's examine the other side of this analysis. What if the supply shock narrative is overblown? It's possible that Mexican production disruptions prove temporary, that mining companies and authorities resolve security issues quickly, that alternative supply sources fill any gaps, that inventory drawdowns at COMEX reflect routine transfers rather than genuine shortage. It's also possible that demand for silver remains soft despite supply concerns, that economic weakness in key industrial sectors reduces consumption, that investors remain focused on other assets and largely ignore silver despite headlines. In this scenario, any price spike would be short-lived. Those who bought at elevated prices would face losses as markets normalized. This isn't a prediction, it's a possibility. And prudent investors always consider the possibility that their thesis is wrong. How do you protect against being wrong? By sizing positions appropriately, by diversifying, by having exit plans, by not betting the farm on any single outcome. Strong convictions, loosely held. That's the mentality. Be willing to act on your analysis, but remain humble enough to recognize that markets are complex, unpredictable, and often irrational for extended periods. So where do we go from here? What should you actually do with this information? Step 1. Assess your current exposure. If you own silver in any form, quantify it. Know exactly how much you have and what percentage of your portfolio it represents. Step 2. Define your thesis. Why do you own silver, or why are you considering owning it? Is it a long-term hedge? A speculation on supply constraints? A diversification play? Write it down. Step 3. Establish parameters. If you're entering a new position, at what price? How much capital? What's your time horizon? What would cause you to sell? Be specific. Step 4. Monitor key indicators. Track Mexican production news. Watch CME inventory data. Follow silver price action relative to gold and other commodities. But don't obsess. Check weekly, not hourly. Step 5. Schedule a review. Set a calendar reminder for 30, 60, or 90 days from now to reassess your position. Markets evolve. Your strategy should too, but not impulsively, systematically. Step 6. Consider professional guidance if needed. If you're uncertain about any of this, if position sizing feels complicated, if tax implications are unclear, if risk management seems overwhelming, consult with a qualified financial advisor who understands commodities and precious metals. There's no shame in seeking help. In fact, recognizing the limits of your knowledge is a sign of wisdom, not weakness. Before we wrap up, let's zoom out one final time. The situation unfolding with Mexican silver is significant in its own right, but it's also emblematic of broader trends that investors need to monitor. We live in an increasingly complex, interconnected world. Supply chains span continents. Production depends on geopolitical stability. Just-in-time inventory systems leave little margin for disruption. This creates both fragility and opportunity. Fragility because systems optimized for efficiency often lack resilience. Opportunity because those who understand these dynamics can position themselves ahead of disruptions, rather than reacting to them afterward. Commodities, energy, metals, agriculture are the physical foundation of modern life. They can't be created through monetary policy. They can't be printed or digitally generated. They must be extracted, refined, transported, and stored. And when physical realities collide with market expectations, when supply fails to meet demand, when logistics break down, when geopolitical stability erodes, prices adjust. Sometimes gradually, sometimes violently. The Mexican silver situation is a case study in these dynamics. It's specific to one metal and one country, but the principles apply far more broadly. Understanding commodity markets, respecting physical constraints, recognizing geopolitical risks, these skills will serve you well regardless of which specific asset you're analyzing. Let's talk once more about the psychological dimension. Financial markets are not purely rational. They're driven by human beings, emotional, biased, often irrational human beings. And that includes you. It includes me. It includes every participant. The difference between successful long-term investors and those who repeatedly suffer losses isn't intelligence. It's not access to information. It's emotional discipline. It's the ability to remain calm when others panic, to act decisively when others freeze, to be patient when others rush, to sell when others are euphoric, to buy when others are despondent. These skills aren't innate. They're developed through practice, self-awareness, and systematic processes that remove emotion from decision-making. When you see headlines about supply shocks and soaring prices, what's your visceral reaction? Excitement? Fear of missing out? Anxiety about being left behind? Notice these feelings. Don't judge them, but don't act on them either. Instead, return to your plan, your principles, your predetermined criteria for action. If the situation meets your parameters, act. If it doesn't, wait. Either choice is fine. What's not fine is acting impulsively because your emotions demanded it. We've covered substantial ground today. We've examined the situation unfolding in Mexico, the supply disruptions, the declining COMEX inventories, the potential for a sustained supply shock. We've discussed historical context, market cycles, and investor psychology. We've outlined strategies for existing holders and potential investors. We've identified critical mistakes to avoid and risk management principles to embrace. Here's what I want you to remember as you reflect on this information. Markets reward preparation, not prediction. You don't need to know with certainty whether silver prices will rise or fall. You need to position yourself intelligently given current probabilities. And you need the discipline to adjust as those probabilities change. No single investment determines your financial future. Not silver, not any asset. Your future is determined by the accumulation of hundreds or thousands of decisions made over years and decades, guided by sound principles and disciplined execution. The current situation with Mexican silver may represent a significant opportunity, or it may prove to be temporary noise. Time will reveal the answer, but that answer is less important than how you respond to uncertainty. Do you respond with emotional reactivity, or with calm analysis? Do you chase momentum, or build positions methodically? Do you overleverage, or size positions prudently? Do you panic during volatility, or view it as a normal feature of markets? These questions matter more than any specific forecast or prediction. So as you move forward, carry these principles with you, not just for silver, for every investment decision you make. Be disciplined, be patient, be prepared for multiple scenarios. Respect risk, manage position sizes, maintain diversification, act from principle, not emotion, from analysis, not impulse. And remember, the goal isn't to get rich on a single trade. The goal is to compound wealth consistently over time, to build financial security through sound decisions repeated again and again. That's the path. Not glamorous, not exciting, but reliable. And reliability over decades is what transforms average investors into financially secure individuals. Thank you for your time and attention today. If you found this analysis valuable, I encourage you once more to subscribe to this channel. We'll continue providing thoughtful, disciplined perspectives on markets, investing, and financial strategy. Until next time, stay rational, stay disciplined, and stay focused on what truly matters. Long-term wealth building through sound principles. Good luck out there.